Nearly 5%, that's the hit Nvidia just took, dragging down chip stocks amidst renewed market jitters. But here's the real story. While everyone's fixated on those daily market headlines, a massive, under-the-radar play just happened in the banking sector, revealing where the smart money is actually moving. Just this month, an individual investor, Trần quietly amassed over 98 million shares in VPBank, making him one of the bank's largest individual shareholders. This isn't about market panic. It's about spotting the colossal opportunities that surface when others are only watching the obvious. For instance, in the last quarter, VPBank saw a 25% increase in its net interest income, with a significant portion of that growth attributed to its growing presence in Vietnam's burgeoning middle class. This isn't some institutional fund making a predictable public move. We're talking about Mr. Trần Thuyen, an individual investor who by July 8, 2026, secured a staggering 1.24% of VPBank's charter capital. That's more than 98 million shares. The sheer scale of this investment, valued at over 2,400 billion Vietnamese dong at current market rates, instantly positions him among the bank's top individual stakeholders. What's wild about this is VPBank's official report doesn't even specify when these transactions occurred, hinting at a strategic, perhaps stealthy, accumulation. It's a textbook example of how massive wealth can be built and deployed without the usual fanfare or media frenzy. Digging into the hard data, VPBank's official update on July 29, 2026, confirms Mr. Thuyen's position based on information provided to the bank by July 8. The report explicitly states his holding of 98,400,000 shares, equating to precisely 1.24% of the bank's capital. To put that into perspective, this single individual now holds a stake larger than many established corporate entities would dare to accumulate quietly. What's even more intriguing is his prior appearance in VPBank's shareholder records back in 2018, where he received 22.7 million shares from Trang Than Business Consulting Co-Limited. That history suggests a long-term, calculated strategy, not a speculative flash-in-the-pan trade, built on deep market understanding. Here's what nobody's talking about. While the mainstream media chases daily stock fluctuations and market jitters, the real wealth is often being aggregated through deep conviction and strategic positioning in less obvious sectors. Mr. Thuyen's move into VPBank isn't just a big buy. It's a masterclass in identifying fundamental value and quietly executing a massive play. This isn't about getting rich quick. It's about understanding market cycles and spotting where capital is flowing before it hits the headlines. For you, the takeaway is clear. Instead of panicking over tech dips, start researching the fundamentals of established, perhaps boring industries like regional banking or specialized finance. Look for stable businesses, solid balance sheets, and quiet accumulation by savvy individuals. Find a sector that's undervalued, learn its ins and outs, and identify an opportunity for a side hustle to service that niche, whether it's through consulting like Mr. Thuyen's past venture, or by building a SaaS tool for a specific industry problem. That's how you start building real, lasting wealth. Don't forget to like and subscribe for more insights into where the real money is being made. Bloomberg analysts are flagging the increasing influence of single, high-net-worth individuals in emerging markets, especially when their stake crosses significant thresholds. This kind of concentrated control, like Mr. Thuyen's 1.24% of VPBank, often triggers discussions around market depth and potential for opaque capital deployment. They're not just looking at the immediate price action. They're modeling the systemic ripple effects that can create market jitters. For anyone building a fintech analysis tool or a market intelligence newsletter, tracking these whale moves before they become front-page news is becoming critical. The opportunity lies in predicting which small tremors become earthquakes. Across the Asia-Pacific region, regulators are intensifying scrutiny on concentrated individual holdings within major financial institutions. Hong Kong's SFC, for instance, has quietly increased reporting requirements for stakes above 1%, aiming to preempt any perception of undue influence or market manipulation. This isn't just about local governance. It impacts how international investors perceive market stability and transparency. Savvy entrepreneurs are building platforms that track these regulatory shifts globally, offering compliance solutions or market entry strategies for businesses navigating these nuanced environments. The global market is getting more interconnected, and so are its vulnerabilities. Rewind to the early 2000s dot-com bubble, we saw similar patterns where outsized individual bets, often masked in complex ownership structures, led to significant market volatility. Remember the stock parking scandals? While not identical to Mr. Thuyan's direct stake, the underlying principle of opacity and concentrated power causing market jitters mirrors today's concerns. Back then, those who built forensic accounting services or specialized due diligence firms saw massive demand. Today, with digital trails, the opportunity for AI-driven anomaly detection in shareholder data or creating a niche audit service for private capital flows is even bigger and more accessible. While retail investors often get spooked by sudden market movements linked to opaque capital, the real winners are often the arbitrageurs and high-frequency trading firms. They thrive on volatility and information asymmetry, quickly capitalizing on the price dislocations created by jitters. On the flip side, smaller, less agile institutional funds, or those tied to specific long-term strategies, can suffer from unexpected swings. This dynamic creates a huge opportunity for anyone developing real-time market alert systems or even building a niche newsletter that deciphers these rapid market shifts for a premium audience. Think about how many traders would pay for that edge.